Welcome traders. Today we're going to be talking about a beginner's trading 101 guide that I built myself that's going to break down all the beginner tips you need to know when you're first dabbling in with the markets, and it's going to help you avoid all these BS mistakes, common mistakes that we all encounter when we first start trading the markets, so you can boost your learning curve and minimize all those little mistakes that's going to slow down your learning curve. Okay, so we're going to jump straight into it. What is an edge? Edge is the most important Edge is the most important thing in anyone's trading journey. If you don't have an edge, there's no way for you to succeed. Okay, an edge, what is it exactly? An edge is just the ability to receive non-random results from the financial markets. Because a lot of people believe that the markets receive or give you random results over a long period of time if you have no edge. Okay, and I fully agree with that. If there's no edge, if there's no statistical advantage for you over the long number of trades, you're going to come out to break even. Just like a coin toss. If you imagine a coin toss as the markets, we don't know what's going to happen immediately after, like the next coin. All we know is there's a 50% chance of heads or tails. But in the long run, we know that we can end up having a theoretical probability of reaching 50%. That's going to equal our observed probability is going to end up being 50%. It's going to equal our theoretical probability. But we don't know that after 10 flips or 10 coin tosses. After 10 coin tosses, we can be really green. We can be, just like in trading, we can be really green. We can have heads 10 times in a row. But after 10,000 flips, if we observe the probability of heads and tails over that entire 10,000 sample, we'll find that we're probably going to be near 50%. And the same goes for trading. If you have no edge, you might think you're doing really good because you might be on a green streak for a little while. But if you continue trading like that, you might observe, if you have no edge, that you'll come out to break even. Those wins will immediately be wiped and you'll come back to break even. So what does an edge do? It leans the probability slightly in our favor. So in the long run, we can have a statistical advantage and actually pull money from the markets. Okay, a very small edge can be very profitable. Okay, we don't need to aim for crazy edges. Now, how do we obtain this edge? First, we have to understand what type of trading style we're going to be or we're going to have. Are we going to go for a systematic approach, or are we going to go for a discretionary approach, or are we going to be hybrid? A systematic trader, all right, actually quick water break. A systematic trader is a trader that sets strict rules for themselves and doesn't break them or doesn't go against them. They only enter setups that follow those systems' rules, and anything that's not following the rules, they avoid it. This is also similar to algorithmic trading, which is basically just building a robot, a trading bot, and having that execute all your trades, which is very different than discretionary trading. Discretionary trading is just not being restricted by set rules, but you might have certain guidelines for entering a trade. As a discretionary trader, you rely mostly on intuition and your gut instinct on what you think is going to happen with the market. And as a hybrid trader, which is personally what I think is the best scenario, you get best of both worlds. You get the rules from the systematic approach, but you're not bound to the strict guidelines of a systematic system. You can also take advantage of the discretionary system, where you also implement discretion and human intuition. That way, now, like I said, you have best of both worlds. If you want to use discretion to adapt your systematic system, or you want to use discretion to adapt the rules of your system, you can go ahead and do that. And that's why I like having that hybrid approach, because it gives you both of those scenarios combined into one. So the only way we can develop this edge is what we need to develop an edge is going to be experience, a lot of screen time, and a lot of data to test our analysis. Because the only way we can develop an edge is through collecting data and making analyses, something like that, and testing our hypothesis, essentially, and experimenting. Basically like scientific method. Come on. But you need to have experience in screen time, and this is why it takes a long time to trade, because you're going to have to take in a lot of data and understand the price action and just the physics of the candles moving up and down. Or you might go down the algorithmic route and develop coding bots, but I believe most of you are going to go down the hybrid approach. Get best of both worlds. So the way we can test our data is through backtesting, which you can do manually on the chart by using the drawing tools, or algorithmically through coding and backtesting through Python, through trading views, PineScript. Or you can forward test, which is essentially just trading on demo and testing your system in the live markets. This takes a lot longer because you have to actually wait for the data to come out, and it could take months for you to actually make decisions about your system and whether a certain parameter that you made is like an actual good parameter or a bad parameter. So that's why I like implementing both. You can do back testing and forward testing and make assumptions through that. Then we have to also figure out what time frame are we going to trade. Are we going to be looking for very quick moves on like 1 minute time frame, holding trades for like a few seconds to like a few minutes, or we're going to hold for multiple days? The types of traders we have are scalper, which is the one I just mentioned, where you hold for a few seconds to a few minutes. We have intraday traders who are holding the trade throughout from a few minutes up to the entire market session or trading day. And swing traders, which are people who trade, or traders who hold their trades for multiple days, more than 1 day, up to like weeks, even months. So you got to figure out which trader you are, and you will figure that out through experimentation. Okay, don't limit yourself when you first start. But we'll get to that later. Next topic is risk management. First, risk management is essentially just money management skills. You don't want to be losing half your account in 1 day. That just means you have no risk management. So every time we enter a trade, we need to know how much money we're going to risk on that trade. How much are we willing to lose on that trade? The only way we know how much we're willing to lose is if we know our stop loss. If you don't know what stop loss is just the exit price that you're going to fully exit your position. Yeah, basically the price that you're going to fully exit your position, because you think once price reaches that point, your trade idea is invalidated and you believe price is going to continue going against you in whatever direction it's going already. Okay. So stop loss is essential, and don't think you're smart trading without a stop loss. Almost all successful traders trade without a stop loss. I don't know a single successful trader that doesn't trade with a stop loss. So anytime you enter a trade, make sure you know where your invalidation point is or your stop loss and your take profit. After you know that, try to understand what percentage of your account are you going to risk on that trade. How much dollar amount do you want to lose if the trade goes against you? Okay, make sure you're aware of that. Along with that, a lot of you guys, if you take multiple trades a day, you're going to benefit from having a max daily loss. Max daily loss will prevent you from going on tilt and losing more money than you decided to. So, because a lot of us, when we first start especially, it's really difficult to maintain our discipline and manage our emotions, which we're going to get into the next section, because managing emotions is one of the hardest things, especially when you're going on a losing period as a beginner trader. So having a max daily loss helps you fully just exit the markets whenever you lost a certain amount, and figuring out your max daily loss will take time. For me, I had to collect weeks of data to understand, and I still don't know exactly what my max daily loss is, but I've just estimated from the data I've collected. After losing a certain amount every day, for example, let's say $500 a day, if I go past that point, most likely I end up losing a large amount. So I set a max daily loss for myself at $500. So if I ever hit $500 or less, or literally when I cross that $500 point on a losing trade, I'm fully out of the markets and I'm getting off my chair and going and doing whatever I need to do for the day. Other than that, I continue trading. And again, make sure you're removing emotions and you're trading with your logical analysis every time you want to enter a trade. Don't be revenge trading and over trading. Just don't be going with FOMO, seeing a trade go in your favor after hitting your stop loss and thinking, oh no, this has to work. I knew it was going to work. I'm going to go back in. Don't. Follow your plan. If that's part of your plan, which I don't think any of you have part of your plan, then go for it. But that's most likely not going to be part of your plan. So remove your emotions. Don't revenge trade or overtrade. Moving on to psychology. This section is not too important. Although if you don't have a good understanding of psychology, I highly recommend you pay attention to what I'm going to say for this section. The key thing for psychology is understanding just having discipline and following the rules that you created for yourself and for your system. Truly, a lot of people think they have a psychology issue with their trading, but what they just have is a not set system. They don't have a system where they've actually described all the rules for it. If they're a systematic trader and discretionary trader, they don't have set guidelines for themselves that they're going to base their idea around. So the best way you can fix a psychology problem, in my experience, is by making sure that you have the rules down for your edge, for your system, and you're you've tested your system to have confidence in it that it's going to work. Because if you have a system that you're not confident in, that's most likely why you're having psychology issues. You might be missing some trades. You might accidentally enter too heavy on setups because you don't know how to properly risk, because you haven't tested what's the ideal risk sizes for your trades for that specific system. So I believe most psychology problems can be solved from just understanding your system, understanding your rules, and having confidence in your system. And how do you have confidence? Through data, through statistics, through understanding that your edge is actually there and you have set rules. If there's any fluff in your system, then that's probably why you are having psychology problems. Like I said, worry about psychology after you've built your edge or your rules. Before, psychology issues are just strategy issues. That's generally true in my opinion, in my experience. And we just talked about that. If you want to learn more about psychology, these are some very prominent people who talk about psychology, and they're very well known in the trading industry to have gave very accurate psychology advice. I also, Mark Douglas, David Paul, and Tom Hugard. Some of these also have books. I believe Mark Douglas and Tom Hugard have their own books, which are very useful. You should check out. I also have a separate section on psychology in my Discord where I include Mark Douglas's YouTube videos. By the way, Mark Douglas has a lot of YouTube videos about psychology, so I highly recommend you check them out. Whether you understand psychology or not, Mark Douglas is very useful. What he talks about can rewire your brain and change your understanding of trading completely. So if you want, you can join my Discord, check out the trading psychology section. I have several hour-long videos recorded there, and a summary if you don't want to watch the videos. But I highly recommend you watch the videos because they're very useful. Moving on, avoid mostly YouTube. The reason I say mostly is because yes, there are some content out there that are useful and are beneficial from traders who are proven to be successful. That information is useful, but most of it is not, because a lot of people on YouTube are just regurgitating information that they heard from other YouTubers who are also unsuccessful, and they themselves who are making those YouTube videos are unsuccessful. So if you see anything flashy, anything promoting their profitable 95% win rate strategy, or you'll 10x your money every week, just anything flashy that seems too good to be true, it most likely is. Yeah, I understand some people, okay, they might be a little bit profitable, but still, just because they got one payout from their strategy doesn't mean they're consistently profitable. That's not enough. One payout is not enough evidence to show that their strategy is the legitimate strategy that only works in the markets, right? Because there's multiple ways to beat the markets. There's multiple small edges that we can build and we can find out, but the hard part is finding out what that edge is, okay? Moving on, just like we mentioned, avoid gurus that are selling signals. Again, flash people are usually going to be usually going to be selling their signal groups, their courses, their AI bots. If they're selling you any of these for a small $45 per month, $49.99 per month, they most likely are going to be unsuccessful. Okay, unless they have proven track record that it works, then it's most likely not. It's a waste of your time, because if it works for them, then they would exploit it to the most they could and make as much money as they could and not tell anybody. Okay, I personally would do that too. If I had an AI bot that was making tons and tons of money, I wouldn't just openly share it with other people, because the more people find out about it, the more the market makers will eventually find out about it. And just in general, in my opinion, the more people find out about a specific edge, the worse it's going to be. So you just want to keep it safe. If you have a successful AI bot, you don't want to be telling people that you have a successful bot, right? You want to keep it to yourself, make all the money yourself, and keep it at that. So you should also check out, like I said earlier, notable traders who have proven track records. There are a few podcasts, like I said, mostly YouTube. There are some podcasts out there. There's one podcast I've heard of. It's called Chart with Traders, I believe. I just recently found out about them, and I've only heard good things about them. I've researched a little bit into them so far, but just for reference, this is just my opinion. I don't know 100% like the background of it, but usually the podcasts from like years and years back from that account are really good. So check them out if you really want to. So, but make sure whoever you're listening to, they're a trader with a proven track record. And you might think people who wrote books are successful traders themselves, but A lot of these people who also wrote books, they never made it in trading themselves. They were never profitable. They're just writing shit just to write shit out and make more money, just like how gurus sell courses. So be wary of that. There's a lot of grifters in this industry. Make sure the books you're reading from are written by successful traders. One of the really good books is called Market Wizards series. It has a series where Jack Schwager interviews a few different traders who are successful. And I think that's probably the most valuable series you can find in terms of books. I haven't dove too deep into them, but I plan on doing so soon. But from what I've heard, they're very good. Market Wizards. And again, one of the biggest things I like to mention is don't limit yourself as a beginner trader. A lot of people say don't try new things, don't try a different strategy, stick to one thing when you first learn it and never change. I don't agree with that. I think when you're first starting out, it's important to try new things. Yes, don't fall under shiny object syndrome. Don't fall under what looks good in the moment, someone selling their profitable strategy. But if you think about something as you're observing the markets, you get an idea, test it out. Be open to testing it out. After all, you're a new trader, you're unprofitable, you want to try new things. Maybe the current thing you're doing is not really making sense to you, and whatever you want to try out might be something that makes even more sense. So collect data on the new thing you want to test out and experiment with it. Back test it, forward test it, and just be open to learning. Always be a student of the game, because like I said, there are many edges in this market. The hard part is figuring out what they really are. Okay? And it takes time and experience and data to figure out and find those small edges that give you the small statistical edge over the market. Statistical advantage. All right. Now, actually, before we continue to actually start day trading, big thing at the bottom, have realistic expectations. A lot of us enter this market or enter this game because we think it's a get-rich-quick scheme. We think we can make a lot of money quick. We saw somebody on TikTok or Instagram or YouTube making $10,000 within 5 minutes and getting off and going to the beach or trading off of his balcony with the view of the beach or whatever and making $10,000. But that's not how trading is going to be when you start, at least. You have to set realistic expectations for yourself that this might take a few years to actually even see some money come out of it. Now, I'm not saying every person's journey is the same, but don't set monetary goals and just unrealistic expectations like, oh, if I'm not profitable in 3 months, then this and that, or I have to be profitable in 3 months and buy this car, or I have to make $10,000 by the end of this year from trading. Like, don't set goals like that, because we all think about the best case scenario. We all expect things that are too good to be true. So it's important to think like the worst case scenario and just plan for that, because the truth is that this is going to take you many years. For most people, this is going to take them at least 2 years to actually gain some like profit out of the markets. And gurus don't talk about this a lot. They tell you, oh, it's 3 months, 6 months, you can get profitable. 1 year, that's more than enough time. No, bro, it's not. There's so much first of all, there's so much BS information you have to dissect through on YouTube. Like 90% of the shit you hear is literally just regurgitated, and it's not actually thought about, and it's not actually like something that the person was telling you actually applies. So make sure you're doing research and filtering out this BS information, and that's also what's going to take you a long time to get through, to filter out and figure out what information is actually legitimate and is helpful. So moving on, how do we actually take our trades? How do we actually start trading? Okay. The best way we can do this is first by figuring out what market do we want to trade. Are we going to trade stocks, options, futures, forex, or crypto? Those are the main markets I can think of. Figure out what market you want to choose and don't stick to it. Again, try new things. If you want to dabble into something else, be open to that. Don't choose one thing and stick to it forever. I started with stocks 4 years ago. I was a little inconsistent 4 years ago, but then I switched to options 2.5 years ago. And then that's when I started being really consistent. I was consistent with options, consistently unprofitable with options. Then I switched to futures. Then I switched to forex for a few months. Then I switched back to futures. And I also dabbled in like crypto very little in between that time. Whatever, it was like literally like nothing serious. But I just opened an account, deposited like $100 and bought some random shit. I'm pretty sure I'm like negative on it because I haven't sold it yet. But yeah, there's that. So pick whichever one you want to try. Test it out. Don't close off the other doors. Okay. Then figure out, are you going to go down the personal account route where you have your own broker, you input your own money and you trade with your own funds, or are you going to go down the prop firm route? If you don't know what a prop firm is, it's essentially companies that fund you with a certain amount of capital to trade with, and you can withdraw whatever profits you make from that certain amount of capital that you're funded with. The catch is that you first need to pass a challenge phase usually, where they'll give you like a simulation account, for example, of $50,000, and you have to reach a certain profit target, make a certain amount of profit on that account without losing a certain amount of money. Okay, and once you pass that challenge, they'll give you access to like funds or whatever, live funds or simulated funds sometimes, and whatever profits you make from that account that you get to keep. You get to withdraw and keep. That's a general guideline. There's a lot more restrictions on the specific like challenge. Like some people might say some companies have like minimum this many trading days, and they just have rules around the accounts to prevent you from gambling and making money just purely from gambling. Okay. And the market you choose also affects the choice you make here because, for example, futures and Forex, there's a lot of prop firms that work with futures and Forex. But for stocks, options, and crypto, I haven't seen many, honestly. So if you're going to most likely go down stocks and options and crypto route, you're most likely going to end up having to get your own personal account and connect with a broker and input your own funds to trade with. And don't get me wrong, they both have their own benefits. They both have their own downsides, so it's all up to your own personal preference. One isn't better than the other. Do your own analysis on that and figure out what is optimal for your scenario. But after everything, I highly recommend everyone start on demo before jumping into a prop firm or personal account. If you don't have an edge and you haven't proven to yourself on a simulation account that you're profitable for at least a certain period of time, like a few months, or making a certain percentage on your account, then you shouldn't be jumping into a personal account or a prop firm if you're not even profitable on simulation. That just makes no sense. So start on demo. If you want to dive into futures, I have Tradeovate. It's a very popular broker, very reliable broker. They have a 2-week free trial for market data, which usually costs money on other platforms, like anywhere from $3 to $5 or more per month. But Tradeovate thankfully has a 2-week free trial where you can access free live data. And this is not what I do, but you could if you want to. I don't do this, but you can make multiple accounts once your trial ends and just continuously use their 2-week trial. I don't do this. I don't recommend it, but it's there. And the link's going to be in the description for that. I also demo trade on Tradeovate, by the way. You can also use TradingView paper trading if you want to paper trade like the other markets. And they're going to cost you some money if you want live data for, like, for example, futures, I believe. I don't know if other ones require live data, but futures, go with Tradeovate. Other ones, I don't really know. Only thing I can recommend is TradingView paper trading because you can paper trade anything. But I highly recommend finding a broker specific to your market and just going with that. Then we have to also figure out what session are we going to trade. The markets are open 23 or 24 hours a day for 6 days a week. Well, with futures at least. Forex, I think it's every day or 6 days as well. I'm not sure. Stocks, a lot less. Only New York's market session from 9:30 a.m. to 4 p.m. Stocks and options. And a lot of people would benefit from just going with New York session because, first of all, we're not going to be trading the entire day. And second of all, New York session has the most amount of volatility. And I think a lot of us will benefit from that. Personally, that's what I do. I trade New York session right at the first few hours of market open at 9:30 a.m. all the way up to 11:30. And just figure out what you really want to trade. That maybe you like the period after that, which is called lunch hour, from 11:30 to like a few hours up to that. A few hours after that, the volatility is very low compared to the market open, and some people it just works better for that. Then we have the last hour of market called power hour, which is where a lot of traders also like to take advantage of the volatility. But personally, I stick to the first 2 hours. So figure out, test, don't limit yourself. Like I said, try new things. Don't limit yourself. Maybe one thing is better for you than the other, and you wouldn't know if you didn't try. So finally, reflecting on your trades. This is the most important, well, one of the most important actually. There's no way you can progress without reflecting on your trades. The best way to reflect on your trades is by journaling and recording your trades. How are you going to journal? You're going to journal by using some sort of spreadsheet software like Notion, Excel, Google Sheets, Google Docs if you really have to. You're going to recap your trades after you're done trading. Like however you want to recap it. But I recommend taking a picture, recording the date, recording some parameters for your entry, parameters for your exit, writing a brief description on why you entered, whether you made any mistakes in your following your rules, your emotions jumped in. Again, like the certain parameters for entering your trade, what were present and what wasn't, and how much you made and how much you lost. Just so for reference, you can go back and understand and see the actual trade and see what notes you took, so you can make inferences on like, okay, maybe that was this trade a losing trade because of something that I didn't follow, where I didn't follow my rules, or because of just a regular good losing trade that is valid loss, part of the system. We don't have a 100% win rate. We're bound to have a loss. Okay. Journaling helps you figure out where you went wrong. It helps you output what was in your mind onto paper so you can better understand where you went wrong. Recording is a lot more beneficial. It's more beneficial. It adds another layer of benefit on top of journaling, basically. I didn't record my trades for like the first like year and a half of my journey, but I found recording to be very beneficial. I record my trades through OBS. I start my recording whenever I start my session, and I record it all the way till when I end. That way I can actually see the live price action and what my thought process was throughout the entire session, which is you can see how that gives you that little advantage over journaling. Through this, I can review my analysis, my thought process, and kind of see how I decide what were my confluences for entering, how price was moving when I wanted to enter, and it just adds more like information to my journaling. If you're not journaling or recording your trades, you just believe that you can understand everything that happens and you remember every single mistake or every single thought that you had, and it will help impact your future trading, which is not possible. You cannot remember. I promise you don't even remember what you ate the last week for dinner every single day. What did you eat? Oh, so now you remember. Oh, okay. Yeah. Cap. Whatever. But I highly recommend journaling and recording your trades. They're going to do so much for you. And it's going to be a little dreadful in the beginning, but you're going to have to do it. And it's going to be very beneficial. So do them and don't ignore them. Okay. This was pretty much our Beginner's Trading 101 guide. All the stuff I said is going to be essential for you to avoid all these tiny BS mistakes. And if you want me to break down a certain topic even more, let me know in the comments. Or if you want to see a separate video on some other topic, let me know. I'll make that as well. I'll do my best to make whatever suggestions you guys have or recommendations you guys have. So thank you for watching. Please leave a like and subscribe. I'm a new channel. I'm trying to grow. I'm trying to help people who are on that beginner stages, or honestly any stage, just trying to document my journey, give any advice that I have. So yeah, if you want to see anything specific, let me know in the comments, and I'll see you guys in the next video.